Good afternoon, everyone, and welcome to the Commercial Real Estate Market Update with our Head of Research and Data Services, Dr. Jeffrey Fisher. I'm Jeff Finn, CEO at RealNext, and our ongoing part of the RealNext webinar series. Delighted to have you back for this year-end special report on trends and conditions of commercial real estate across the country. Jeff is the president of the Homer Coit Institute, advisor to NCREIF, and professor emeritus at Indiana University, and literally wrote the book on real estate finance and investments, published a publication used by many of the graduate schools of real estate around the world. And Jeff's been providing us with his expertise and insights into real estate trends and conditions for the past many years, and it's been just a fascinating cycle that we've been part of, Jeff, and it seems to be continuing and unabated into the year end, and look forward to hearing your findings from NCREIF and other research work that you've done. So let me turn it over to you. And of course, as we go through the session, if anyone has questions, use the chat question box on your screen, and we'll do our best to address them as we come towards the end.
Okay, thank you, Jeff. Should be able to see my screen.
You got it.
So I think on the flyer that we sent out, we had, is this the season to be jolly? So we'll see as we go through the slides here. But I think we're going to be pretty happy with some of the returns that we've seen for commercial real estate this past quarter, the third quarter of 2021. And from everything I'm hearing, it's going to be pretty strong going into the fourth quarter, which of course we're pretty well through at this point. So as you can see from this chart, institutional real estate at a 15-year high. Who would have thought a year ago when everybody was talking about, rent decreases and rent renegotiations and, the impacts of COVID. And, here we are. I think on the first slide I had there, are we back to normal? I guess we're above normal in terms of being above average with our returns. You can see what happened during past recessions, like 2008, 2009, and we just had this really slight drop in 2020, but back at pretty much record levels. If we look at it over a longer history, which we do here, you can see that we're up there, pretty much near the highest that we've ever had in the history of the index. So again, since this is a longer view, you can really see where recessions during the early 90s and again 2008, and those were far more of an issue than we had during the more recent COVID crisis. This also breaks out the return into the income and capital. Most of you have probably been to past webinars, so you kind of know how this works with the data here that comes from institutional investors, where they mark their properties to market every quarter. So that allows you to calculate a quarterly return, kind of like an internal rate of return, but just for one quarter, and then you just chain link those together. So each quarter you have a capital return, which is your change in value net of any CapEx you put in the property, and then the income return is the income that quarter divided by the market value at the beginning of the quarter. Most of the variation over time is really a result of the changes in the value of the properties, of course, the income because of the nature of the leases and so forth, and the fact that we are marking the market every quarter. The income return tends to be relatively stable, although it has been dropping along with the drop in cap rates. Market values. This is an index of how market values have changed over time, kind of like a price index. So if you started at the beginning of the NCREIF Property Index, NCREIF is National Council of Real Estate Investment Fiduciaries, which is most of the major institutional investors that contribute data. You can see that if you start off at 100 in 1978, you're over 450 now, and a record high in the level of the price index. Sold properties. These are properties that sell every quarter out of the index. That's actually a good sign, because they're also acquiring properties, and that indicates we have a liquid market. Usually sales are down when the market is weak, and sales are up when the market is good. People are readjusting their portfolios and doing reallocations across different property types and different sectors. So we like to see the transaction activity up at a higher level, not at an all-time high here, but it's up above an average level of transactions. In investment volume, according to currently recent CBRE report, you can see that that's also at high levels compared to what we've seen since 2011. And same idea with lending activity. We can see lending activity is way up there compared to what it had been going back to 2008. So returns have improved for all sectors, but wow, just look at industrial, which is 90% or more warehouse properties. There might be some data centers mixed in there, although data centers tend to show up sometimes in office and sometimes in industrial. Same with life science, which has really made a difference across the performance of the industrial and office sectors. Some life science tend to be more industrial in nature, some more like office. But look at those industrial returns. And again, these are quarterly returns. So for 2021 third quarter, that's the notation here, 2021-3 is the third quarter, you can see over a 10%, about an 11% quarterly return. I mean, that's just obscene. We've never seen anything like that in the entire history of the index, where you've got that high return for a single sector. Apartment returns also pretty strong. I see a lot of news articles coming out about the rent levels going up for apartments. One article said it slowed down a little bit this quarter, but still way above what it had been a year ago. So pretty strong returns in apartment. If industrial wasn't so high, that we would say that's pretty good, 24% roughly on an annualized basis. And then all the returns really are seeing improvements from what they were last quarter. Office is up, retail is up, hotel is up. So all the sectors improved, which is good. And then you see this over a little bit longer time series basis for apartment, industrial, office, and retail, kind of the four main property types that are tracked by the institutional investors. Although, as I'll show you later, there's more and more interest in moving outside of these main sectors into other property types, whether it's self-storage or nursing homes, student housing, or life science, health. Just a lot more interest in other sectors than we've had traditionally in these large open-end and closed-end funds managed by the institutional investors. But again, you see this divergence between the performance of industrial and really all the other property types, but especially between industrial and retail. It's good to see retail did improve, because there for a while it was industrial going up and retail going down for the reasons that we all know about, the shift to online shopping and the need for more warehouse space. For some reason, it just kind of dawned on me today when I was reading an article what was really causing a lot of the demand for a warehouse space. I mean, we know there's online shopping and Amazon building and needing warehouse space. But for a lot of companies, and I remember and this was a long time ago, that I was a student at Purdue University in the business school and had this course in production management, and we learned about different inventory models, and a lot of companies moved and have been moving for many years towards this idea of just-in-time inventory, where they had everything worked out, where they could get inventory just when they needed it for production. Well, with the supply chain problems that we've been having, and due to COVID and other factors going on in the economy, companies can't rely anymore on getting those goods when they need them right away. They've got to store stuff in advance in warehouse space. Look at the shortage we've had with semiconductors and how that's impacted Apple. Can't find an iPhone 13 anywhere anymore. And maybe they're starting to come into stores now, but there for a while you couldn't get one unless you ordered one and waited for a month to get one. So it's really that the need to move away from that just-in-time inventory and relying on it that's really created a huge demand for warehouse space for all different kinds of companies, not just for the online shopping. This is something Glenn Miller, a good friend of mine at the University of Denver, does every quarter. He breaks it out across a lot of different property markets, different CBSAs across the country. So this is just kind of at a national level what's going on, where he shows where different property sectors are within kind of the property life cycle, where properties tend to start off at, or at least in this chart, it starts off where they would be recovering, which the way Glenn kind of does this, it's based a lot on where their occupancy is relative to the long-term average occupancy you'd expect for that property type. And he's shown that rent growth tends to be highly correlated with where occupancy is compared to what's average. And so you see that retail really shows up several different places because it really depends a lot on the type of retail. You see the second, third tier retail is down there at the number 2, which is really kind of a recession level, maybe starting recovery, but we don't know how long it's going to take, to get back to that long-term average. There's really no time on these charts, and in fact, property types don't always move really nicely, evenly from like a 2 to a 3 to a 4 and so forth. But I think probably we'd all agree that your second and third tier retail is kind of hurting right now, whereas if you look at neighborhood centers, community centers that are more necessity based, grocery store anchored, those tend to be at the high, number 11, where those have recovered nicely. And that doesn't mean they're necessarily going to decline and go to a number 12. Again, there could be a long timeline until it does start to move down and its occupancy moves back to more of a long-term average. But I think we'd all agree that that type of retail is, and you'll see that in the NCREIF data as well, that's what's been performing the best. Office, you can see it at a number 8. We'll see some differences if we look later on between suburban and downtown. And what else? Apartments doing well, as we talked about earlier, up there at a number 11. So if you're interested, I think this is available from the University of Denver. I don't think there's any charge for this subscription every quarter. Looking at that market value index by property type, it's interesting here how look how industrial apartment was ahead, leading the pack for a long time, mainly because it got off to a good start early on, and at least in terms of an index level where everything starts at 100, it pretty much led throughout the whole history of the index until it just got slightly edged out by the industrial this quarter. You can see that green line, industrial, just really took off. Actually, starting back in 2010, if we'd have only known, right, just how strong it was gonna be all these years. I'm always amazed at the kind of the herd mentality, although there are certainly fundamentals to support it. But once a property type gets going, it just seems like it keeps going for quite a while. We know it can't continue forever. At some point, there's got to be another property type that ends up being the best performer. That supply automatic at some point has to come back online. So let's get your opinion. Then I'm going to show you some survey results from institutional investors. What property sector do you think will outperform or perform best, I should say, in 2022? So we know what it's going to be for 2021. So let's kind of look ahead to maybe the end. Doesn't say that here, but by the end of 2022, and we look back, will it still be industrial, or will apartment that's been coming on strong lately, or maybe even office if people do end up going back to work, or even retail that's been beaten down and maybe will recover. So we'll see what everybody says here. And polls. There we go, so I can see it. So we have 31% apartment, 66% industrial, nothing for office, nothing for retail. We do have 3% that voted for hotel. Interesting, and this is pretty much in line with the results we got from the institutional investors when we did this for them a couple of weeks ago. So industrial is just going to continue that momentum, but apartments, look like they've got a good chance of also being the winner. Interesting. Okay. So this is a survey. It actually just came out. I think it was last week, from the Pension Real Estate Association. That's an organization, again, of institutional investors and a lot of the large pension plans around the country that do a consensus survey of where the NCREIF, a lot of acronyms here, but the NCREIF that I've been talking about, returns will be going out to 2025 in this case. So you can see for 2021, I think for all of the year of 2021, including this fourth quarter, we're going to have a total return of 30.8%. 30.8%. Wow. Office 5%, retail 2.5%, apartment 15%. If it weren't for industrial, we say, wow, apartment 15%. That's a pretty nice return, at least from what I can remember of where we would normally expect returns, especially for investment grade institutional real estate. 15% is a pretty nice return, and we would never in a discounted cash flow model be discounting future cash flows at 30%. Maybe especially for unlevered returns to be using that high discount rate. For 2022, we see things going down a little bit, but it's more returning to a normal level, right? As we go out 2023, 2021 to 25 average over the 4 years, whatever that is, we see 8%, pretty nice return for all the property types combined, and again, you see the breakdown for the different property sectors. So overall, that seems like a pretty nice forecast for the outlook for returns for commercial real estate. Nobody is really seeing any big recessions here. We'll talk about inflation here in a minute, but maybe that'll even help the returns. We'll see if people tend to think that. These are some charts of the same things I just talked about, just showing 2015 history of what the return was out through the forecast that we just talked about in 21, 22, and 23. So really strong finish for the year 2021, and dropping back to more normal levels in 2022 and 23, and kind of the same story across each of the different property sectors that we see in the bottom chart. Occupancy has been good. Apartment occupancy over 90%. Hotel around 60. Don't normally see a real high occupancy level average overall for hotel. Industrial, can't get much higher than that, moving up there close to 100%. And then you see also for office and retail, really looks pretty good in terms of what it is for the properties held by the institutional investors at a 90% occupancy level. And then flipping that into vacancy, you see more of a time series across the different property sectors. With industrial, of course, they're really low. Occupancy, especially compared to what it has been historically, you do see it moving up a little bit for each of the other property sectors. And then NOI growth has been at really good levels, about 3% NOI growth, which is kind of a good rate. And you can see here across the different property sectors, what the strongest markets were. A little different across each market. San Francisco being the strongest for apartments, Dallas for office, etc. And then rent growth, you can see how it had dropped off due to COVID into the negative territory, but really came back very strong. And in fact, the rent growth now is higher than it's been since we need to go back to before 2008 to have a rent growth that's at the 6% level. Maybe part of that's because we're coming off of a lower rent level, but certainly a nice level of rent growth. And then again, looking at NOI instead of rent, looking at the NOI across the different sectors over time. And they've all improved, which is good. So a lot of these charts are certainly showing some improvement. So the big question on everybody's mind right now seems to be inflation. There was just a webinar that same organization I showed the consensus survey from, Pension Real Estate Association, did earlier this week, where they were talking about what the impacts of inflation might be on commercial real estate. And the director of research at the Pension Real Estate Association, Greg McKinnon, did this study where he looked historically at what the returns were at times when we had different levels of inflation, low, medium, and high, but also coupled with what the GDP growth was, whether it was low, medium, and high. And his conclusion was kind of that it's not really inflation that mattered so much, it was GDP growth. That when we had strong GDP growth, that's when we had the highest returns, whether it was low inflation environment or a higher inflation environment. So maybe we should be more concerned about what GDP growth is going to be, which I think the last forecast I saw was still pretty good GDP growth compared to historically. So maybe we don't need to be quite as concerned about inflation. Real estate historically has been a good inflation hedge. There's some questions as to whether that'll be true going forward. One of the reasons that I think it was an inflation hedge during some of the periods we had historically of high inflation was we already had CPI adjustments built into leases. And I can remember, Jeff, when like in my textbook, you know, the example for office buildings had to have a CPI adjustment as part of the example of how you calculate and forecast rents for office buildings and other property types. And we had these CPI adjustments, and that's pretty much gone away for many years. So we don't have some of the things built into leases that we used to protect the owner. Of course, we still can raise rents when the leases roll over if the economy is strong. We still have expense pass-throughs in a lot of cases, or net leases. So not that we don't have ways to have the inflation protection, and real estate being a real asset tends to allow it to have inflation protection since costs go up. I've read lumber costs starting to go back up again. So there is sort of a cost push as well as a demand pull side to the inflation. But Greg also looked at how you can see the effect of a 1% increase in inflation. And it was kind of interesting that for NOI growth, you can see that with 1% increase in inflation, apartments, the NOI growth increased by about 1%. Industrial didn't keep up with it historically. Although I'd have to say that going forward, in fact, from everything I've been hearing, rents have been rolling over on warehouse space at much higher rates. So I would think if inflation comes back, industrial is going to keep up with inflation and have more than a one-for-one increase with any increases in inflation. I think I skipped over my disclaimer at the beginning that, you know, don't believe anything that I say that might be construed as a forecast. But my guess would be that industrial is going to do well if there's inflation going forward. Office, kind of a 0.6 increase for every 1% increase in inflation, and a little bit less for retail. Cap rates, and you know, a little cap rate 101. So what causes cap rates? Well, cap rates is kind of a combination of interest rates, but they tend to be reduced by expected future growth because cap rates are based on current income. And if part of your return is going to be from increases in income in the future, then you're willing to buy it at a lower cap rate. So with inflation, the higher growth can actually pull down the cap rates. At the same time, the higher interest rates may be pushing up cap rates. And so they could completely offset each other. And you see here, Greg found historically with apartments, there was no impact on cap rates. What that means is the higher interest rates were offset by the higher growth rates. Not quite as true for industrial, although these are pretty low numbers on the scale, 0.1%. So industrial cap rates did go up a little bit. Office cap rates kept up with the inflation. Some people say a cap rate is like a real rate of return. So it's like the real rate of return held constant with the inflation. Retail, and this kind of surprises me. I would think retail would have been one that would keep up with the inflation because of the percentage rents. But at least in this study, the cap rates on the retail did move up slightly when you had the inflation. In terms of its impact on property values, so here, 1% increase in inflation, 1% increase in property value for apartments. So again, the 1 for 1, it kept up with inflation. That's what you want to see. It's a hedge. It should move up 1 for 1. Industrial was 0.6. Office kept up, actually a little bit more so, is above 1%. Retail didn't keep up, which is consistent with what we talked about with the impact on the cap rates. So who knows what the future impact will be, but everybody's kind of asking the question right now. In fact, I just saw today where CBRE came out with their forecast of inflation, and although they show this temporary inflation spike, kind of like the Fed has been talking about it, they are projecting that it's going to come back down to where the Fed wants it. Maybe that'll be because the Fed will raise rates or do something to bring it back down. But they're not forecasting, and I don't think most economists are forecasting that we're going to have a big permanent jump in inflation. But I guess the Fed did take out the word transitory in the last comments on results in the Fed meeting. So a little bit of breakdown by different sectors or subsectors, I should say, within each of the main sectors. So you can see here that suburban had been outperforming the office, the CBD, I should say, and it still does. The suburban office has been doing better than the CBD office. I think a result of COVID, and the story in a lot of these sectors, as we talked about in the past, is moving to less dense areas. So you see high-rise apartments not doing as well as the garden apartments, garden being less dense than the high-rise. And we see strong absorption of apartments space from the CBRE data. And you can see where the largest absorption has been New York, LA, Houston, other end of the spectrum. We've got Orlando, Minneapolis, and Tampa. In terms of retail, as we talked about before, it's the neighborhood centers and community centers that have been doing the best. The regional, not as well. Although the higher tier regional, I think the really good malls are still doing quite well. I think some of the Simon malls have been doing quite well around the country. David Simon was a former student, so maybe that's why his malls are doing well. Probably not. So self-storage, I put this in because, again, there's a lot more interest in other sectors, or I should say alternative sectors to the main property types everybody used to always invest in. Self-storage has been one of the hottest, and you can see it had a really nice recovery, getting up there around a 9% rate of return on a quarterly basis. And so ranked with the other property types, you can see self-storage was actually second after industrial to the third quarter returns. And so there's just been a lot more interest in the alternatives. the alternatives, meaning those other property types like self-storage and parking and student housing, seniors housing that are collected by NCREIF, but not in the main index. Those have been increasing as a percentage of the data that's being collected. In fact, that organization is going to be making a switch to where the main index includes all these other property sectors, because your large, even the low risk, what they call core funds, are investing in all these alternative property sectors. And so the feeling is that they should be in the main index, whereas we used to think of just, the apartment, industrial, office, and retail, a little bit of hotel. And now we're thinking more broadly. Even single family residential, I think, will end up being in the index. Single family residential investments, that is rental property. Cap rates still keep coming down, an teensy bit every quarter, and track very closely with the BAA bonds as we've looked at in previous webinars. And it's really the cap rates coming down, the cap rate compression, the red bars in this chart, that have really contributed a lot to the rate of return, with cash yield due to the NOI being next, and actually the NOI growth, though, has come back to where it's not hurting us anymore. You see the green was hurting us for several quarters until the current quarter. It looks like the green went away. So NOI growth, as we saw, has been more positive. This is annualized, so it's not showing a lot of green there in that final bar, but we know that the NOI growth is now helping returns for this quarter, combined with some cap rate compression. And then by the different property types, looks like in office, actually, I'd say held steady, but the apartments have been coming down. In fact, look how much apartments have come down compared to the other sectors. And industrial also coming down, industrial being just right above apartments in terms of the cap rates. So what will cap rates be for the nation by the end of 2022? Not the end of this year, but by the end of 2022, since a lot can happen between now and then. We're currently around 4%, so will they keep going down below 4%? Will they kind of stay in the current range, maybe go up a little bit as maybe the Fed gets a little stricter and pushes up interest rates a little bit? Or does the Fed miss the boat and inflation takes off and real estate not an inflation hedge like it's been historically, and so they go up to the 4.5 to 5% range or above 5%? And boy, we're getting some mixed results here, aren't we, Jeff?
It is interesting this time, for sure.
Yeah, 45% think we're going to be kind of where we are now to up a little bit, but 17% think we're going to be below 4, whereas 24%, not that much different, think we're going to be 4.5 to 5, and 14%, so we're kind of skewed to the upside. 14% think it's going to be above 5%. So I was almost going to say it's a normal distribution until I saw the 14% above 5. So we are, to use a statistical term, skewed to the right here a little bit. So skewed towards the positive. But again, well, maybe I shouldn't say again. Cap rates going up, that could hurt us a little bit. But if that's coupled by the NOI growth, and we saw in all those forecasts pretty optimistic outlooks. So I guess I'm still not too worried. Here you see the top 20 markets for investment volume: LA, New York, San Francisco, Dallas, on down. And then what I did with the NCREIF data is look to see which combinations of CBSA and property type were the major movers of the index, one way or the other. Industrial, Riverside, CBSA, California, Riverside, San Bernardino, Ontario, that alone moved the index up by 37 basis points. Just industrial and that CBSA moved the entire index by 37 basis points. On the other hand, office in New York and New Jersey moved it down by 27 basis points. So you kind of get the idea here. It gives you an idea, especially for institutional investors. If you weren't in Riverside Industrial, it'd be pretty hard for you to beat the index. Not that you couldn't, but that sort of puts you at a disadvantage. And if you were in, at the same time, you were over allocated in office in New York, you know, that hurts you. So you kind of get the idea here. And these were the major movers. And that's something I did that was kind of new this quarter is ranked each of the CBSAs where the most capital was from the institutional investors, from the highest amount of investment down to the lowest. And so Riverside, and then ranked the return. So Riverside had the highest return, as we just saw, was really, really strong in terms of the industrial, and that pulled up its total return to the highest level. And then that goes down through, again, just the top 20 by amount of capital invested. So you see at the other end of the spectrum, you see DC and San Francisco. So it really made a difference where you were in California. And then I did the same thing for each sector. So for each sector, what were the 20 that had the most capital? That's going to differ from what we had when we combine all the property types together. You know, so in terms of apartments, these are the CBSAs that had the most capital invested. I didn't shorthand the names of the CBSA here, so you see the longer names, but you see Phoenix, Denver, Fort Lauderdale, et cetera. So for apartments, what did the best was Phoenix, followed by Denver and Fort Lauderdale CBSAs, and then down through San Jose. I guess I didn't mention on the previous one, I also put on here the occupancy. I just thought it'd be interesting to kind of see, okay, let's see how the returns correlate with the occupancy. You'd expect that where there's higher occupancy, there's higher returns. And at least when looking at it on a national basis, like we're doing here, looks like there's a pretty good relationship. I mean, it's not perfect. I put in a trend line there for the occupancy. It's labeled percent leased here because it actually comes out of accounting data, but you can see where you have the higher occupancy, you tend to have the higher return, which is what we'd expect, right? And the same is true for the different property sectors. It's not, I mean, there's always going to be exceptions to the rule, but you tend to see the higher occupancy along with the higher returns. So industrial, kind of see the same relationship, couple of exceptions. And you see, again, where your stronger returns were for the top 20 industrial markets down through where the lowest returns were. And then for office and retail. Got some negatives there for the New York retail at the far end. But Atlanta had the best return, followed by Dallas CBSA and then the Houston CBSA. So where will institutional real estate values be by the end of 2022 compared to now? So now we got to kind of put everything together and say our value is going to be somewhat lower by the end of 2022. Returns and values will stabilize at the current level. Values will be somewhat higher by the end of 2022, or you can admit it, you have no idea. And we did see some survey results, so you sort of have an idea what institutional investors are thinking. And maybe it becomes a self-fulfilling prophecy, although we saw returns not necessarily the same as values. And the results are all in. We see 15% somewhat lower. 30%, they're going to stabilize at the current level. 37% is going to be somewhat higher. 19%, and I may join you. Hard to say, no idea. So again, sort of skewed towards values will be higher. Although that's a little inconsistent with skewed towards cap rates will be a little bit higher, isn't it, Jeff? But again, NOI growth and other factors could still end up saving us. So it's going to be interesting to see what happens over the next couple of quarters. I think overall, we're probably pretty optimistic. As a summary, national returns at a 15-year high, price levels at a new high, industrial, another all-time high among many other records that it's set this quarter in terms of occupancy levels and other things. Transactions are back to normal levels, and cap rate compression is still helping us. So I think overall, it kind of looks like a jolly season. Again, from what I'm hearing, the fourth quarter, I hear appraisers are already busy doing write-ups, and of course, things could change over the next couple of weeks. Who knows? But so far, it looks like we're gonna end the year on a high note. So, any questions? I'm sure the other Jeff can answer them.
Yeah, don't know about that, Jeff. You're the expert, so have done the most recent research. In fact, there were some questions along the way which I did answer, and they're more, certainly we are going to share the deck. We will have a video. We'll have a report that comes out based on the session today, and that'll be posted and distributed, and probably early next week we'll get that out. And I think you covered it well, Jeff. I think for the past couple of years, you've said the cap rates can't get much lower, and they haven't gotten much lower. They've gotten lower. They just continue to. I don't know. It's defy expectation. When you have so much money going into the market, it was inevitable. That there's all asset classes are going to be bid up. Yield's going to be bid for. And yields will go down, values will go up. That's the weight of money on the sidelines still will put pressure. I'm not sure if you have any perspective on the new round of monetary policy and how that will impact going forward and what you can expect.
Well, we know that the Fed is going to try to keep inflation under control. So that could be a little bit of a damper, but again, if the inflation is just relatively temporary, and the new strains of COVID don't turn out to be an issue, and the supply chain gets back to normal, the Fed shouldn't have to do too much. And I think they clearly are going to cut back on their asset purchases. But then we also have a lot of money, there's going to be a lot of money coming into the economy through all the different government programs.
Another $1 trillion coming in, so that's got to find its way through the market. And I guess we're just about through the year-on-year comparisons to the price decline during COVID. And I think that's not as much part of the conversation as it should be. These inflation numbers are still compared to a COVID impacted decrease in value and the supply chain disruptions that are possibly putting a abnormal increase as things get back to normal. So the comparisons will start to change as we get into Q1 of 22. And I think that's what everyone's waiting for, to see if we continue to grow on inflation on top of the post-COVID environment versus the COVID environment.
The next couple of webinars could be interesting.
You didn't talk about it today, and one of the questions just came in. What does the flow of capital into funds look like? I don't know if you've got your chart or you've got.
I had that chart and took it out at the last minute. Maybe in part because I don't have a good answer for what happened. There was actually more distributions than contributions into the large open-end funds, which is kind of contrary to what we saw in terms of the optimism and the returns. And I think part of that is taking profits on properties. And so, you're distributing that capital back to investors where they were able to take profits, and having a hard time finding good opportunities to invest in right now because of the prices having bid up. So the net flows into the large open-end funds were actually slightly negative, but I don't necessarily see that as a bad sign. There is a lot of capital out there. It's just kind of, I think, waiting to see what's going to happen over the next couple quarters.
I don't know your perspective on this, but a question in particular is about Amazon's future growth and the impact on industrial. You see these 1 million square foot industrial buildings going up all across the country, and it's just Amazon, Amazon, Amazon. Are they the only ones out there, or are there other factors fueling the industrial market growth?
Yeah, they're not the only ones, but they sure have a hell of a head start. I mean, I think I get something from Amazon about every other day. Just like
that's almost every hour. It depends on where you're at, whose house you're in, but they're coming around the clock and even on Sundays now. So it's amazing.
A lot of it is even the same day. They just built a giant new warehouse just about a mile. I bike by it almost every day. Near where I live in Henderson, Nevada. They had such a head start over everybody else. I think it's going to be an Amazon story for a while. But again, I'm not so good at forecasting, but certainly I've been helping support Amazon.
Looks like we've gone through the questions. You've covered the material well. Yeah, I think we should be optimistic as we go into the year end and into 22. From a industry standpoint, transactional levels have been high. The RealNext clients, the brokers that I've been talking to, have had record years in many cases in most markets, depending on what property sector they're working in. So we wish you all well into the holidays. Hope you all did have a great year and finish it strong and have an even better and more successful new year as you go into 2022. So we thank you for all of your support, and we wish you well, and we'll look forward to having you back here on future webinars. Next week, if you're a RealNext client, you might want to join us for the Nick Miner webinar, the Mastermind webinar. We'll be working with him to showcase some of his best practices using the RealNext CRM, and look forward to speaking with you all at that time, next Thursday at 5 Eastern. So have a great afternoon, and we will see you all soon. Bye-bye.
Thank you, Jeff.